All right, so you're tuned into the deep dive, and, something tells me a lot of you out there have been wrestling with this question. REITs and InvITs in India.
Mm-hmm.
Like, what are they really all about? How do they actually stack up against, let's say, your usual investments? Can they really boost your returns? And
Yeah.
I get it, sifting through all that info can feel like, well, a real slog.
Yeah, definitely.
But, consider this deep dive your shortcut, right? We're cutting through all that clutter.
Absolutely.
No jargon overload, just clear, insightful stuff to help you really grasp these investment options. And look, we've gone deep into the research here. We're talking academic papers that put REITs and InvITs head-to-head with the Nifty 50.
Yeah.
We've tapped into what investors are actually saying online.
Mm.
We've even explored some fascinating connections, like how REIT returns might react to get this volatility in the gold market.
Right.
Pretty interesting, right? Plus, we'll unpack how powerful tools like machine learning are shaking up REIT analysis.
Yeah.
And, of course, we'll break down the whole regulatory landscape in India.
Makes sense.
So our mission here is really straightforward.
Straight to the point.
We're boiling down how these investments actually perform, how you can start analyzing them, and the crucial considerations for you, the investor, right here in India.
The key takeaways.
Exactly. We want you to walk away with a rock-solid understanding without needing to, become a financial whiz overnight.
I like it.
All right, so let's start from square one. What exactly are REITs and InvITs in the Indian context, and why are they even a thing here?
Well, it all goes back to 2014 when SEBI introduced them. And the reason? India's real estate and infrastructure sectors were, and still are, booming. But funding these massive projects, that's a whole other story. So REITs and InvITs came into play as a way to, well, essentially gather funds from a bunch of investors.
Mm-hmm.
They could then invest in these large-scale assets and hopefully see some returns.
Got it. So instead of one big company financing a whole highway, it's more like a lot of smaller investors chipping in.
Exactly. Think of it as pooling resources. Now, REITs mainly focus on commercial real estate.
Okay.
So we're talking office buildings, shopping malls, warehouses, those kinds of property.
Makes sense. And InvITs.
InvITs, they're all about infrastructure, things like highways, those massive power transmission lines you see,
Yeah.
pipelines, you name it.
So big, tangible stuff.
Exactly. Real assets you can, actually see and touch.
Right. So not just some abstract financial instrument.
Precisely. And,
Yeah.
they didn't take off immediately. There was a bit of a, I guess you could say, a slow burn. But then around 2017, things started to shift. We saw the first InvIT hitting the stocks exchanges, followed by the first REIT in 2019.
So those were like the turning points.
You could say that.
Yeah.
And to answer your earlier question about whether these were brought in to solve a specific funding problem, the answer is a resounding yes.
Okay.
They were designed to be alternatives, ways to bridge the funding gap, especially in the infrastructure sector.
Mm-hmm.
And if you look at more developed economies, you'll see REITs and InvITs have been quite effective at financing large-scale developments.
Interesting.
So with India's regulatory framework getting more and more robust, it makes sense that they're gaining traction here.
Right. So they're basically here to fuel growth. But now here's the million-dollar question that's probably on everyone's mind. Do these actually deliver? Do REITs and InvITs actually give you better returns than, let's say, just sticking with the good old Nifty 50 index?
The classic question. And honestly, it's not a simple yes or no answer. The thing is, REITs and InvITs in India, they're still relatively new to the game.
Mm-hmm.
We just don't have that long history of performance data to look back on and definitively say, yes, they consistently outperform traditional investments.
Makes sense.
Their future performance, well, it hinges on a lot of factors. You've got the overall economic climate, how stable those regulations remain, and, of course, investor demand. Whether people like you are actually interested in putting their money in. It's important to remember they're not a magic bullet for guaranteed higher returns.
Right, no free lunch in the market.
Exactly.
Now, we did come across a research paper that tackled this very comparison.
Oh, you mean performance analysis of REITs and InvITs in India? A comparative study with the Nifty 50.
That's the one. They really went all in using a bunch of financial models to break down performance.
They did a very thorough analysis.
They used the Sharpe ratio, which I know can sound a bit technical, but basically it tells you how much extra return you're getting for the amount of risk you're taking on.
Yeah, that's a good way to put it. Risk-adjusted returns, essentially.
Right. And they also used the Mann-Whitney-U test to compare the median returns, the chi-square test, to see which one outperformed the other more frequently, and Pearson's correlation to see how their returns, kind of move together.
It's like they threw the whole statistical toolbox at it.
They did. So after all those tests, what was the verdict? Did REITs and INVITs come out on top?
Well, the results were actually a bit mixed. When they used that chi-square test, to see which one outperformed more often, they didn't find a statistically significant difference. So they couldn't definitively say that one consistently beat the other.
Interesting.
And when they looked at those median returns using the Mann-Whitney U test, they had to use that because, sometimes that return data isn't perfectly normal. The p-value they got was pretty high, like 0.98.
Okay, and remind us again, what does that p-value actually tell us?
So the p-value essentially tells you how likely it is that the results they saw were just due to random chance. So a high p-value like that, it kind of suggests that, maybe it wasn't a super strong conclusion.
Yeah.
They couldn't definitively say that the Nifty's typical returns were actually lower than those of REITs and INVITs.
Got it. So in terms of just the average returns and how often they beat the market, REITs and INVITs weren't clear winners. Now, what about how their returns move together? That's where that correlation analysis comes in.
Right. So what they found with Pearson's correlation was that there was a statistically significant, moderate, positive correlation between how the Nifty 50 performs and how those REITs and INVITs perform. The p-value this time was less than 0.05, which means it's unlikely that it was just random.
Okay.
So it suggests that their returns, to some extent, they kind of move in the same direction. If the market's doing well, chances are both Nifty and the REITs and INVITs will also be doing all right, and vice versa.
So they're not completely independent of each other.
Exactly.
Which kind of, has implications if you're thinking about diversifying your portfolio.
Exactly. You're not getting, the full benefit of diversification if they're always moving in sync.
Right. Now, what about risk? We've been talking returns, but what about the risk side of things? That Sharpe ratio should give us some insight there.
Absolutely. When they analyzed the risk-adjusted performance, using that Sharpe ratio with data from 2019 to 2023, here's what they found. REITs and INVITs, they had an average expected return of 4.48%. Nifty, on the other hand, was much higher at 32.79%.
Wow, that's a huge difference.
Yeah, quite a significant difference. But here's the thing. REITs and INVITs, they did show lower volatility. They had a standard deviation of 187.17%, while Nifty was higher at 260.96%. But despite those bigger swings in the Nifty, guess what? It still provided better risk-adjusted returns.
Interesting. So even though it was more volatile, you were getting a better return for the risk you were taking.
Exactly. Had a higher Sharpe ratio. And in the end, what really matters is, are you getting rewarded for the risk you're taking on?
Right. It's all about that balance. So during that specific time frame, the Nifty 50 actually gave you a better bang for your buck, so to speak.
That's what the data suggests, yeah. REITs and INVITs actually showed worse risk-adjusted performance in that period.
Okay, that's really important to know. Lower volatility might sound appealing at first, but if the returns aren't there, it's not really a better deal, is it?
Not really, no.
Now, let's say someone's actually thinking about, okay, I want to put some money into REITs in India. How do you even begin to assess a REIT fund? It's not like looking at a regular company stock, is it?
It's not, and that's a great question. One of the online discussions we came across had some really practical advice on this. They emphasized that analyzing a REIT fund is actually a bit like analyzing a debt mutual fund. The key is to really dig into the portfolio.
Okay, so it's about looking under the hood and seeing what they're actually investing in. What are the key things we should be looking at in that portfolio?
So first and foremost, you want to understand the types of properties they hold. Are we talking office spaces, hospitals, shopping malls, data centers? What's the mix?
Makes sense.
Then you've got to consider the geographic spread. Are these properties concentrated in one city, or are they spread across different regions? Mindspace REIT, for example. They've got a presence across some major business hubs like Mumbai, Pune, Chennai, Hyderabad.
Okay, yeah, that makes sense. Diversification.
Exactly. And then occupancy rate. That's a big one. You want to see a consistently high occupancy rate.
Yeah.
Generally around 85–90%. That's considered pretty healthy. Means they've got stable rental income coming in.
Right.
And then the weighted average lease expiry, or WALE. Basically how long those leases are. A higher WALE is generally better because it means those leases are locked in for longer, so you've got more predictable income coming in over the long term.
Right. Longer leases, more stability.
Exactly.
Yeah.
Globally, over 5 years is often seen as good. And in India, you might even see examples in the 6 to 7 year range.
Wow.
So yeah, longer leases generally translate to a more secure income stream.
That makes sense. Now, what about the financial health of the REIT itself? Are there any specific numbers or ratios we should be looking at?
Absolutely. So revenue, first and foremost.
Right.
For a REIT, that mainly comes from rental income.
Okay.
And you want to see a nice upward trend, right? You want to see that revenue growing consistently.
Makes sense.
Then you've got net property income. That's basically the revenue minus the cost of maintaining those properties.
Uh-huh. So it gives you a sense of how profitable the actual real estate is.
Exactly. It's a measure of profitability. And then the distributable income to unit holders. That's the profit that's left over after all the expenses and taxes. And it's what gets paid out to investors.
Okay.
Now, when it comes to debt, there are a few key metrics to keep an eye on. First, the interest coverage ratio. That's basically how easily the REIT can cover its interest payments.
Okay.
A higher ratio is better. Mindspace, for example, they have a ratio of around 4.5 times, which means their earnings can cover their interest payments 4.5 times over.
Wow, that sounds pretty healthy.
Yeah. It's a good indicator of financial strength. You've also got the weighted average cost of debt. Lower is better there, obviously. Mindspace is at around 7.7%. And then the weighted average maturity of debt, basically how long until they have to refinance.
Okay.
A longer maturity means they don't have to worry about refinancing as often, which can be helpful if interest rates are rising.
Right. So it reduces that risk.
Exactly.
Okay, so we've looked at the portfolio, we've checked the financials. Now, how do we figure out what a REIT is actually worth? What are the key valuation parameters?
There are a few key ones to keep in mind. First, the fair value of NAV, or net asset value. Think of that as the REIT's estimate of what their assets are worth, minus their liabilities, divided by the number of outstanding units.
Okay.
Then you've got the price-to-book ratio. That compares the current market price of a REIT unit to its NAV per unit.
Okay.
And here's something interesting. Indian REITs often trade at a discount to their NAV, typically in the 14–16% range, though it can fluctuate depending on how the market is feeling.
Interesting. So you could potentially get a bargain.
Potentially, yes. Then you've got the dividend yield, which is basically the annual distributions you get as a unit holder expressed as a percentage of the current market price. Mindspace, for instance, had a trailing 12-month distribution of around 18.74 per unit.
Mm-hmm.
And lastly, you can look at the price movement of the NAV itself over time.
Mm-hmm.
You can use those technical analysis tools to spot trends, maybe identify good entry or exit points.
So it's kind of like combining a fundamental analysis of the assets with a bit of technical analysis of the market price.
Exactly. You want to look at the intrinsic value, the financial strength, and then see how the market is currently valuing the REIT.
Makes sense. Now, what about actually buying and selling units? How liquid is the Indian REIT market? Can you easily get in and out?
Well, liquidity is something that's still developing in the Indian REIT market. The average daily traded volume, it tends to be between 5 to 10 crore rupees. Now, compared to some of the more popular stocks, that's not huge.
Okay.
But the good news is there's usually market making.
Now, for those who don't know, what does market making actually mean?
It means there are entities out there that are always ready to buy and sell. They provide continuous bid and ask prices, which makes it easier for you to actually trade. So if you're a retail investor, looking to invest a few lakhs, you should generally be able to buy or sell without too much trouble.
Okay.
Though it's always a good idea to use limit orders, especially for larger amounts, or even iceberg orders. You really want to be careful.
Good tip. Now, let's shift gears a bit. One of the research papers we looked at explored a really fascinating connection between gold market volatility and REIT returns. It's not something you'd immediately think of, is it?
Not really, no. It was a very interesting study. They basically looked at whether fluctuations in gold prices, specifically how volatile they were, could actually predict returns in the REITs market. And they looked at this across different sectors and regions.
Okay.
And what they found was that, generally speaking, when gold prices were getting more volatile, REIT returns tended to go up.
Huh. That's counterintuitive.
It is, isn't it? But it wasn't always consistent across all the time periods they looked at.
Oh, interesting. So how did this connection change over time?
So before the global financial crisis, back in 2008, they noticed that the effect was more sector-specific. It seemed like investors were more likely to shift to REITs in those specific sectors where they saw them as a safer option than gold when gold prices were jumping around.
Okay, so kind of a flight to safety within specific sectors.
Yeah, you could say that. But then, after the global financial crisis and during the COVID pandemic, they saw a broader effect. REIT returns went up across more sectors and regions when gold was volatile.
Interesting.
So it seems like during those periods, REITs might have been acting as more of a general safe haven, especially when the overall market was a bit more stressed. So it seems like the role of REITs as a safe haven, it kind of evolves depending on what's happening in the broader economy.
That's fascinating. So not just a one-size-fits-all relationship.
Exactly. And to make sure their findings were solid, they also checked the relationship between stock market volatility and REIT returns.
Dude.
Well, the results they got kind of backed up their findings about gold. It added another layer of support to the idea.
So there's some real evidence there to suggest a link between these two seemingly very different asset classes. Pretty cool, right?
Definitely. It shows how interconnected things can be in the financial world.
Right. Okay, moving on, we also looked at another paper that used some pretty sophisticated tools to try and predict wheat prices. They were using machine learning and even incorporating technical analysis. Tell us about that.
So this study was all about using those advanced algorithms to try and predict where REIT prices were headed. They use things like ordinary least squares regression, support vector regression, k-nearest neighbors, XGBoost, even a neural network called LSTM.
Okay, now those are some big words.
Yeah, they are. But basically, these are all different ways of, training a computer to spot patterns in data and make predictions.
Makes sense.
But what was really interesting about this study was that they didn't just use historical REIT prices for their predictions. They also added in technical analysis indicators, or TAIs.
TIs, okay.
Yeah.
And those are those indicators you see on stock charts, like moving averages, the MACD.
Exactly. Those are used a lot in the stock market, but not so much with REITs.
Interesting.
And their big finding was that these machine learning algorithms, they generally did a better job of predicting prices than traditional statistical methods.
Okay.
But here's the kicker. When they added those TAIs into the mix, their predictions got even more accurate. Like, in some cases, they reduced their errors by a whopping 60%.
Wow, that's huge.
It is, isn't it? It's a massive improvement. So not only were the algorithms themselves powerful, but adding those TAIs seemed to give them an extra edge.
That's really impressive. But did those better predictions actually translate to better investment outcomes? Did they actually make more money?
Well, they did some simulations where they built portfolios based on their predictions. And those portfolios that used the predictions with the TAIs, they consistently outperformed the ones that just used past prices.
So those technical indicators really did make a difference.
It seems so. They even used some advanced techniques like Shapley values to really analyze the importance of different factors in their models. And they found strong evidence that those TAIs were adding real value. And here's another interesting thing they found. Adding those TAIs also seemed to make their predictions more reliable for other asset classes like bonds and stocks.
So it's not just limited to REITs.
Exactly. This approach might have broader applications. And in the end, they showed that using these TAI-driven machine learning models, it could actually lead to better risk-adjusted returns when you're managing a portfolio that includes REITs, stocks, and bonds.
So even though most of us probably aren't going to be building our own AI models anytime soon, it's still pretty exciting to see how these more advanced tools could potentially give investors an advantage.
Absolutely. It's a glimpse into the future of investing.
All right, so let's bring it back to Earth for a moment. For our listeners in India who are thinking about investing in REITs, what are some of the crucial things they need to consider, and what are some of the challenges specific to the Indian market?
So there are a few key things to keep in mind. Taxation is a big one, and it can get pretty complex in India.
Yeah, I imagine that's not always straightforward.
Not really, no. The income you get from REITs can be taxed in different ways depending on where it comes from. You've got interest income, you've got the repayment of debt at the SPV level, and you've got capital gains. And each of these is taxed differently.
Okay.
For instance, any interest income or taxable dividends you receive, that's generally taxed according to your individual tax slab. But then the repayment of that SPV debt, that's currently treated as a non-taxable return of capital.
Okay.
And then when you sell your REIT units, any profit you make is subject to capital gains tax.
Right.
Short-term gains, less than a year, are taxed at 15%, while long-term gains, more than a year, are taxed at 10%. And to make things even more interesting, the specific way different REITs structure their payouts can actually affect how your distributions are taxed.
So, yeah, definitely something you want to look into carefully and maybe consult with a tax advisor.
Absolutely. Now, liquidity, as we talked about before, is another consideration. It's still not as high as it is for some of the blue chip stocks.
Right.
And the regulatory environment, well, it's still evolving. So it's something investors need to stay informed about.
Keep up with the changes.
Exactly. And we also came across some discussions online, and this is more anecdotal, but some people were speculating that the increased transparency of REITs might actually deter some investors who are used to the, shall we say, less transparent world of direct real estate. So, there's this theory floating around that some people might be hesitant to jump in because everything's out in the open. And initially, SEBI regulations only allowed REITs to invest in commercial properties that were already completed.
Okay.
So that might have limited their appeal early on. And while the potential is definitely there for REITs to become more popular, the level of retail investor participation so far, it seems to be relatively low.
So, still some hurdles to overcome.
Yeah, for sure.
Now, what about investing in REITs indirectly, like through a mutual fund that specializes in them? Are there any advantages to that?
There can be, particularly when it comes to that whole tax situation. So when you invest in REITs through a mutual fund, the income they distribute, it actually just gets added to the NAV of the fund.
Okay.
So you only get taxed when you actually sell your mutual fund units.
So it can simplify things from a tax perspective.
Exactly. And we're also seeing these new small and medium REITs, or SM REITs, emerging in India. They have a slightly different set of regulations, and they can even invest in residential properties.
Oh, interesting. So that opens up some new possibilities.
It does. And remember, real estate is often seen as a good hedge against inflation, and that extends to REITs as well.
Right. So that's another potential benefit. But it is interesting that, despite those regular dividend payouts from Indian REITs, their overall market capitalization hasn't really taken off yet.
It is, isn't it? It's something to keep an eye on.
For sure. Okay, we've spent a lot of time on REITs. Let's talk a bit about InvITs. How do they compare, and what are the key differences investors should know?
So if we compare REITs to investment trusts, and in this case we're talking about investment trusts that are similar to how InvITs work in India, there are some key distinctions. Investment trusts are usually closed-ended funds. They issue a fixed number of shares, and that's it.
Okay.
They can also borrow money. They often have a longer-term investment horizon, and because of that, they have the potential for both higher returns and greater losses.
Higher risk, higher reward.
Exactly. Now, unit trusts, which are more like your typical mutual funds, they're open-ended. They can keep issuing new units, they distribute income regularly, and they can't really hold on to too much cash.
Okay.
Now, Indian NVTs, they often have a more predictable cash flow because their revenue comes from those long-term infrastructure contracts.
Right, things like toll collections and power purchase agreements.
Exactly. And those returns, they can be pretty attractive. Some even mention yields in the 10% range.
Wow.
But just like REITs, the tax implications can get a bit complicated.
All right.
So always good to look into that carefully.
Great. Okay, so we've covered a lot of ground here. As we wrap up this deep dive, what are the key takeaways you want listeners to remember about REITs and InvITs in India?
So the main points to keep in mind are that REITs and InvITs, they offer unique ways to invest in those growing real estate and infrastructure sectors here in India. They can potentially give you some diversification in your portfolio, and they offer that potential for regular income. But when you compare them head-to-head with equities like the Nifty 50, their performance has been a bit mixed. It's crucial to look beyond just the returns and really analyze the quality of those underlying assets, the financial health of the REIT or InvIT itself, and how it's currently valued.
Right. Due diligence is key.
Absolutely. And the regulatory landscape is always evolving, so staying informed is really important, particularly when it comes to taxation.
That seems to be a recurring theme.
It is, isn't it? And for some investors, especially those who might be new to all this or don't want to deal with the complexity, investing indirectly through a mutual fund might be a simpler, more manageable approach.
A good option to consider.
Absolutely.
Great summary. It definitely highlights that there's no easy answer, right? REITs and InvITs are not a guaranteed win, but they do offer some interesting potential. So as a final thought for our listeners, considering how much potential there is in India's real estate and infrastructure sectors, and with those regulations constantly evolving, how might REITs and InvIT become even more important for individual investors in the coming years? It's a question worth pondering.
It is, yeah.
I think it all comes down to, your own individual risk tolerance, your financial goals, and how comfortable you are with these types of investments. So for those who are interested, I encourage you to do your own research, dig a little deeper into specific REITs and InvITs that catch your eye, and of course, stay up to date on any regulatory changes that might impact these investments. Thanks for joining us on this deep dive. It's been a pleasure exploring this topic with you.
It has, yeah. Thanks for having me.